So here are some stocks that you should watch out for. First of all, Bed Bath & Beyond dropped hard today, over 20%, because it missed earnings. It did miss earnings by a lot, but that doesn't really justify a 20% drop, in my opinion. For example, I'm an average investor. Let's say I found out that a company that I have stocks in did not make as much profit as it was expecting. Am I going to panic? Is that going to make me panic? Is that going to make me lose trust in the company? Does that change the operations of the company, the business model of the company? It's not enough to make me question the whole business model of the company. I mean, a company that makes billions in revenue and in profit, just because for one quarter it missed earnings. First of all, I wouldn't go panic and sell. I'd be disappointed. I'd be crushed. Maybe I'd buy some more, but I would not sell. So I really don't think this volume, this movement is caused by the average investor. I think it's big institutions selling it. There's more people selling than there are buying. So it has to be big institutions selling for some reason. I'm positive it's not related to the earnings. It's not that big of a deal to drop over 20%. So Bed Bath & Beyond is definitely a stock to watch. At this price, it's at a 52-week low, of course. It's going to have pretty high yields now. If it continues to pay its dividends, it's going to have a pretty high yield, above 4%. So it pays 64 cents a share on 14, and it's per quarter. Yeah, so it's going to be about 4.3% yield if you buy it at this price. So yeah, retail, of course, people are starting to buy online more. So the trend is more towards online, but it does not mean that retail will disappear. So it's not a threat, especially if it's a company that knows how to run their operations. I mean, it's just consumer behavior that they have to predict. They'll have to adjust their operations or prices so they can meet expectations. And if you look at the revenue, so revenue is growing, so that means they're selling. But at the same time, cost of revenue is also growing, so that's normal because they're selling more. But it doesn't seem to be the same percentage. So if we look at, let's say, 7639, so let's say we look at 2017, 7639 divided by 12,215, it's about 60. So 62% of their revenue is cost for 2017, but for 2018 it should be around the same, 64. Yeah, so it grew about 2%. So that probably means so they're selling more. The fact that their sales are growing means they're selling more, but they're probably selling at a discount, which would explain the increase in revenue, but the drop in profits. Because if you look at net income, so yeah, they've sold more in 2018, but they've profited less. Or fiscal year end 2018, they've profited less. So in 2017, they sold 12.2 billion, but they made 685 million profit. In 2018, they sold slightly higher, 12.3 billion, but they made much less profit. They made 400 million instead. So it looks like a good buying opportunity right now. If you trust that it's not going to go bankrupt, it's a good buying opportunity. Chart wise, of course, it looks good. It's at a 52-week low. So you can see for the past year, it's been above 14. Past 5 years, it's been above 14 for the past 5 years. So it's been above 14 for since 2009. So this is almost like a 9-week low for this stock. So it's definitely a good buying opportunity. 1-year target price, according to Yahoo Finance, is 17.82. It gives it a underperform rating. So it's not a buy recommendation, but it's an underperform rating. Let's look at the balance sheet to see how much debt it has. So current assets, they've got almost 4 billion in current assets. And in current liabilities, they have 2 billion. So they're able to pay their current debt easily with their liquid assets, total liabilities, and they've got way more assets than they have liabilities also. So it looks strong. Really nothing to worry about. Bankruptcy is not in play here, and they're profiting every year. So every year they're making more profit that they can use to pay debt or increase their equity. So I honestly don't see what the issue is here. So I see this as a buying opportunity. GM is another stock definitely I'm watching. I actually bought this stock at 34. this week. I bought it at 34. It dropped to 33, but I'm happy at 34 because initially I was going to buy it at 35.5. So 34 for me is a good price. Pays 4.5% dividends. It's a stock on Warren Buffett's list. Yahoo gives it a 1-year target price of 45. If you look at the charts, yeah, definitely 1 year looks good. 5 years, if you look at 5 years, it's been above 35 probably maybe 2-3 years. Let's look at financials. So 145 billion in revenue last year. No particular growth in revenue. 2014 was 155. So they actually made less revenue than 2014, but still big numbers, high numbers. So basically what I'm looking at is anything that would make me afraid to buy the stock. As long as the stock won't disappear, I don't care what happens in the short term. If the price looks attractive, then I'm going to buy and just hold on to it as long as I have to, and then sell it at a profit. And while I'm holding on to it, I'm collecting dividends. That's why I try to focus on stocks that pay dividends, unless you have a Facebook opportunity, of course, even though Facebook doesn't pay dividends, but it's definitely a stock you should buy because it's got huge potential growth, or huge growth potential. So it lost money in 2017, 3 billion loss. So you got this here that probably caused it, minority interest and discontinued operations. It's most likely discontinued operations. So they probably took a loss on something that they got rid of. So it caused them a huge loss for 2017, but it's not going to continue. It's not something in their regular operation. So it caused a buying opportunity for us now, but as soon as they continue, they go back to their regular behavior, regular profits, then the stock is going to go up. So GM is another stock I recommend to watch. This is a really good stock in my opinion. I wish I had more money. I wanted to drop below 30 and I'm buying it for sure. Honda Motor. 1 year target price according to Yahoo is 35. It pays 3% dividends per year. Market cap 54 billion. And if you saw my video on Honda, financials are ridiculous. This is 15 trillion last year with 1 trillion profit. So absolutely nothing to worry about. Definitely a good stock to buy, a stock you can trust. Let's look at the balance sheet quickly. So total current assets 7 trillion. Current assets with total debts or current liabilities 5.5. So they can still pay off their debts easily. And their equity, yeah, they definitely have more assets than equity. They have about 8 trillion of assets more than they have liabilities. So that's good. Look at the chart for 1 year. It's close to the 52-week low. 5 years, yeah, it's been trading probably like 3 years above 30 max. All right, so it hasn't, so above 30 probably since 2005. So it had moments where it dropped, but besides that, it's been trading above 30 most of the time. So that's comforting. And if you look at expert reports, I think they're all good if I remember. So Morningstar probably gives it a 35 fair value or 40 something maybe. 33 only, 34 fair value. And CFRA gives it a buy recommendation with a 34 target price. So it's not that huge, but I still trust this stock because I know the product that it sells and it's not going anywhere, this company. I'm also watching Dividend 15 Split Corp. I actually contributed to my RESP, so which is with Investor's Edge, so I can only buy things in Canadian. So I'm looking at Canadian stocks, and this is a stock I'm looking to buy because of its high dividends. I put an order already at 5.25. It didn't go through yet because the stock didn't drop to 5.25, but it's dropping. Hopefully tomorrow it reaches at least 5.25. And this is probably a stock I'd be holding forever because of ridiculous dividends that it pays. I don't need to buy and sell it. Just keep it forever. Also watching Dollarama, 13 billion market cap. It's at a 52-week low. See, as you can see here in the chart. Now, I remember I was watching this stock before it did a stock split. It was around 110, 115, and then it just shot up to 150, I believe, or 140, 150. Then it did a stock split and it ended up at 50. Yeah, 56. So it was at 56, the high. And now it just dropped hard to 41. So just based on the charts alone, it looks like a buying opportunity. 1-year target price according to Yahoo Finance is 48, so that's good. Dividends are not so high, not even 0.5%, so dividends not great, but it's got good potential for capital gain. If you look at financials, so revenue is increasing, and without even looking at financials, just by looking around me and looking at the stores and looking how fast they grow, there's always more stores opening up, and there's always a lot of people in the stores, so that alone tells me that the company is doing well. So yeah, and revenue, as you can see, is growing year after year. Net income is also growing, yeah. So last year they made $500 million in profit with 3 billion in revenue, which is actually pretty good numbers, because that's 15% profit margin. That's pretty good. So I don't see why the stock dropped. So current assets, $500 million. Current debt, yeah, so they have more debt than they have assets. So if they need to pay their debt, all of a sudden they wouldn't have enough to pay their debt. They'd have to rely on future income to pay off their debt. So maybe that part is not so comforting, but let's see the previous years. Is their debt going down at least? No, their debt is increasing. So their current debt is increasing, while their current assets is stable. So yeah, that doesn't look too good. Either they're not managing their money well. Yeah, and they've got more liabilities than assets in total. Looks like they're not managing their money well. Unless they're putting it in inventory right away. Not bad. Yeah, so that's probably why the stock dropped. So revenue and sales and profit wise, it looks good, but on the balance sheet it doesn't look too good. But I would still buy the stock. Maybe I wouldn't put much in it, but I'd put an order before yesterday at 41, but it reached 41.03, and then it went back up, and today it's at 41.55. I wasn't watching it, so I didn't see how close it got to 41, but then I just canceled it and put an order on Dividend 15 Split Corp instead. But I'm looking to put an order on this stock as well, Dollarama. So both Dividend 15 Split Corp and Dollarama are on the Canadian Stock Exchange. And the famous Ford here that's absolutely killing me, especially on the option side. But I love that they're paying 6.5% dividends per year. So Yahoo gives it a 1-year target price of 10.84, but it just keeps dropping, so that's annoying. I honestly don't know why. I don't see what's going on. The only thing I know is that they're restructuring a few things, but not enough reason for the stock to drop, especially if they're able to sell. As long as you're selling, there's nothing to worry about. Revenue is growing, so from 2014, 144 billion to 156 billion in 2017, and their profit is also growing, 1 billion in 2014 to 7 billion in 2017. So absolutely, there is no problem. 7 billion in profit can fix a lot of things. Let's look at the balance sheet. So if you look at the balance sheet for Ford, so current assets, you could see for 2017 is 115 billion, while current liability is 94 billion. So they have enough. If they have to pay their debts, they can pay it. But if you look at the growth, their current assets are growing, yes, and their current debts, their short-term debt is also growing. They've got more total assets than they have liabilities, so that's good. So I guess they're leveraging their debt to generate revenue, or buy assets that help them generate revenue. So probably their high debt is probably the reason the stock is dropping, but besides that, I don't see why it's dropping. So I see this as a buying opportunity. I already bought some at the last price I bought at was 9.85. So if it drops below 9, I could probably buy more stock. I'm not gonna buy options again because I'm not patient, and I'm starting to worry because I need the stock to reach almost 11 by 2020. By January 2020, I need the stock to reach 11, or else I lose everything I put into options. All right, so these are some stocks to watch out for. If you have any questions, leave them in the comments below. Any stock tips, also leave them in the comments below. I like sharing stock tips. I've actually made some profitable trades based on some stock tips. Also, don't forget, if you're going to open an account with Questrade to start trading on the stock market, use my referral code in the description below the video so you can get between $25 and $250 depending on your initial deposit. And once you open your account, you'll have your own referral code that you can use to refer your friends. Thanks for watching.